Hello, I'm Grace. Employment data released in the United States has shaken financial markets, triggering a chain reaction across New York stock exchanges and the Korean won exchange rate. Employment growth that significantly exceeded expectations has raised fears of reignited inflation, which directly translated into expectations of further interest rate hikes. Non-farm payroll figures were reported well above market forecasts. This outcome was interpreted as a sign of an overheating economy, providing decisive grounds for the sustainability of the Federal Reserve's tightening policies. The Federal Reserve's interest rate policy stance is increasingly likely to shift toward greater tightness. Markets have begun to reassess, anticipating that the Fed will maintain higher interest rates for a longer period. Sensitive to these expectations, New York markets plunged sharply. Heavy selling of high interest rate sensitive tech and growth stocks drove indices down significantly. The Nasdaq Composite Index recorded a decline of nearly 4% in a single day. This figure suggests the market has moved beyond a short-term correction into a deeper adjustment phase. Shares of major corporations like Philips plummeted by over 10%, surprising investors. Broadcom also fell by 12% despite improved earnings, exposing the limits of the bullish trend. Global capital is returning to the U.S., accelerating weakness in the Korean won. As funds flow in to chase higher U.S. interest rates, the $1 exchange rate broke through 1,561, approximately 1.37 USD per 1,000 KRW. While rising exchange rates can benefit export companies, they trigger higher import prices. This poses a structural risk that undermines domestic price stability and can lead to rising consumer prices. High long-term interest rates increase borrowing costs for businesses, dampening investment activities. This can be a fatal blow, particularly for companies with high debt ratios or new startups. As consumers face higher loan interest burdens, fears of an economic downturn are growing. In an environment with high household debt, rising interest rates can lead to reduced consumption. Our economy is directly exposed to these global financial volatilities. While a strong dollar brings short-term capital inflows, the risks of inflation and economic slowdown are far greater. Individual investors should reduce their exposure to risky assets and hold more liquid assets. During periods of high market volatility, constructing a defensive portfolio has become crucial. Corporations must now strengthen exchange rate hedging and reschedule debt repayment. Building internal resilience against external shocks is essential for survival. Market volatility will persist depending on the signals sent at the Fed's next meeting. The future interest rate decision process will be the key variable determining market direction. This is a critical period requiring calm judgment amid unstable markets. We advise reviewing portfolios from a long-term perspective, avoiding being swept up by emotions. I'm Grace, thanks for watching.